So now we're going to see how to create a diversified portfolio. Typically, the recommendation is to own a collection of equity-based mutual funds or individually managed stock accounts. So first, let's look at what the typical investor does under the advice of a broker on his own. If we look at a time frame from 1991 to 2010, based on a study done by the Dalbar Group, which measured actual investor behavior, we see drastically different results from the published return of mutual funds as a whole. The annualized rate of return for investors investing in equity-based mutual funds from 1991 to 2010 was a dismal 3.83%. This is very discouraging. What happened? Was the market that bad over the time period covered, or was something else going on? The answer can be found with other data from the Dalbar study. The average investor's holding period was slightly more than 3 years for the 20-year time period covered. So rather than buying a fund and holding it for the long term, what happens is the average investor chases market performance in the following way. The investor buys a mutual fund or a collection of funds based on some ranking system or on the advice of a broker. These funds, which have had superior performance over a period of time in the past, are likely to be heavily invested in one or two market segments and not greatly diversified. When these market segments go sour, the investor sells the funds and then buys ones which are currently performing better. We call this phenomenon changing the market, and this was evidenced by the Dalbar study. Also contributing to the extremely low annualized returns for investors over the 20-year period are hyperactive stock picking and attempts to time the market, both systems of changing the market. So how can we improve this? Had investors stayed fully invested in, say, the S&P 500, rather than chasing market, the annualized rate of return would have been 9.81%, 3 times the return, with about 10% less volatility than the average investor if you look at Portfolio 2. So just by making the move of owning a broad market index of S&P 500 stocks and not timing or playing with the portfolio, we increase our return exponentially with less volatility. The next thing we're going to do to the portfolio is include some fixed income. Previously, when we discussed the market factor, we said that an important decision facing an investor is the percentage of the portfolio invested in fixed income versus equities. In this example, we're going to use 40%, with 20% in a 5-year government bond portfolio and 20% in a 1-year fixed income portfolio. This is only done to manage risk. So by placing 40% of the portfolio into these fixed income assets, we dramatically reduce the volatility from a standard deviation of 18.53 to a standard deviation of 11.66. And it does very little to change the expected return if you look at the comparison between Portfolio 2 and Portfolio 3. The next way we're going to improve the portfolio is we're going to add some international stocks. So here, instead of having 60% in U.S. large companies, we're going to move 30% into the European, Australian, and Far East funds, the EFA index. Stocks in this index represent the largest stocks on a global basis outside of the United States. The impact of this global diversification in Portfolio 4, it adds about 10 basis points of expected return for only about 4 basis points in additional volatility. That's a pretty good trade-off. What's more, it increased the probability of benefiting from geopolitical diversification. Now we're going to alter the portfolio to address factor number 2, the size factor, by including some U.S. small cap and international small cap stocks. Based on the percentages shown in Portfolio 5, there is a dramatic increase in expected return with a nominal trade-off in the impact of volatility. Finally, we'll adjust the portfolio to address the value factor by adding 7.5% U.S. small cap value stocks and 7.5% U.S. large cap value stocks, and adjusting the percentages across the other equity categories as shown in Portfolio 6. We obtain an annualized return of 10.99% with a standard deviation of 12.12%. So how does this compare to the average investor's return in Portfolio 1 of 3.83 with a standard deviation of 19.79? And how does it compare to the all S&P 500 portfolio in 2, 9.81 to 18.53 in standard deviation? So without using any of the failed methods of traditional investing, picking stocks, timing the market, or using a manager's track record, we've engineered a portfolio with better returns and reduced risk. Portfolio 6 has a 10.99% return, and that's with 40% fixed. So now, none of this matters. We've been talking about the different types of investing, the traditional investing myths, and the story of investing, and we've created a diversified portfolio and we've shown some returns. But as I stated at the very beginning, the opportunity here is to achieve true peace of mind, and you don't necessarily achieve true peace of mind from the returns in your portfolio. You get that from knowing what you're doing and why you're doing it, which is going to set up the next video and the last video in this series. We're going to give you a quick quiz to give a snapshot of where you stand and see if you know about all this information that we've just discussed. So go on to the next video and we're going to talk about the 20 must-answer questions for true peace of mind.